So what is a settlement statement or an escrow statement, and why is it important in a real estate transaction? You may have seen what's called a HUD-1 or a settlement statement in a real estate purchase, but you may not be aware that this is the most important document in arranging the figures and numbers in your real estate purchase or even a sale. Whether you're the buyer, the seller, a real estate broker, any party to a real estate transaction is intently interested in the numbers on the settlement statement, because it will go through and outline every dollar that's going into or out of that transaction. And you may think that a real estate transaction is pretty straightforward, right? If somebody's buying a house for $350,000, the seller gets $350,000, the buyer pays $350,000, and that's the end of it. But there are many, many more calculations that go into the final numbers other than just the price. For example, if the real estate is sold by a broker or an agency, that broker or agency receives a commission, and that will come out normally of the seller's proceeds. However, sometimes the money that was paid as a deposit by the buyer is held by the broker. So now that's a credit to the buyer, a debit to the agent. So let's take a look and see how a settlement statement is put together, how the calculations go, and what you can expect to see if you are a buyer or a seller, especially if you're a buyer. The federal guideline for real estate transactions require that the escrow agency or the title company that's performing this transaction provides you with a good faith estimate of a settlement statement in advance of the purchase. It may be 48 hours, it may be 7 days, depending on the scenario. In many cases, your mortgage company will also provide you with a copy because it's going to have important information about your mortgage as well. So let's take a look at it frame by frame and see what are the important elements to look at. Here's the top of page 1. Basically, this has the names and addresses of the party, the borrower, which is the buyer, the seller, the lender, normally is involved in most transactions. If it's a cash transaction, typically it'll use the same form. It'll still say borrower, but that just means buyer. The property location will be specified here. Settlement agent is the escrow company. This is all pretty much straightforward information. Now, if you notice, there's 2 columns. These 2 columns are intended to be side by side, but to show the running score for both buyer and seller. The first most important item is the contract sales price. That's going to be the same on both sides. If it's $300,000, it's $300,000. If there's any personal property included in the transaction, that's listed separately. Sometimes a house is sold for $350,000 and there may be personal property like a boat or a shed or something that's not part of the real estate that's sold as personal property. Sometimes the furnishings of the house are sold as personal property. You notice below that there are 2 blank lines. That's for additional information. If you notice, there are settlement charges to borrower, line 1400. This is the total of basically what most people refer to as closing costs. It says line 1400. That comes from down lower and is put on this line. 2 things to take away from this section. First of all, notice that the first 3 things are what the buyer has to pay. Buying the house, buying the personal property, and settlement charges. Those are what the buyer has to pay. On the seller side, this is what you're getting money for. How much for the house, how much for the personal property. If there's other items, they go on these other lines. Okay? So, adjustment for items paid by seller in advance and adjustment for items paid by seller in advance. Well, here's what happens. Let's say that you are buying a house on April 4th, 2022. It doesn't matter what year, but April 4th. And let's say that this house has property taxes, which almost every piece of real estate has property taxes. The taxes are normally billed to the property owner at the end of the year. So on December 31st, the county will send a bill to the owner for the prior year. These are paid in arrears. So in 2022, December 31st, the owner gets a bill for the taxes for that house. Well, that tax bill is going to be for the whole year, January 1st till the end of the year. Well, that owner didn't own the house from January 1st until April 4th. So they're paying a bill for property tax for the whole year, but they didn't even own it for 3 or 4 months. So there's an adjustment made to where the taxes are what's called prorated. And it makes even a bigger difference if you're buying a house at the end of the year. If you're buying a house in November, you don't want to pay taxes for the whole year because you only own it for a month. So that's where other adjustments are made. And we'll take a look at another document, how this looks in real life with numbers on it. So what gross amounts are due from the borrower and what gross amounts are due to the seller? First of all, is there a deposit or earnest money? If you're buying a house, at some point you pay a deposit. It might be $1,000, it might be $5,000, it might be $10,000, it might be $50,000 as a deposit. Somebody is holding that money. It might be the real estate broker, it might be the title agent, the escrow agent. It's probably not the seller, but it doesn't matter who's holding it. That's a credit that you have coming to you as a buyer because you already paid that money. So if the house was $350,000 and you already paid a $20,000 deposit, well, at the closing, which is what this document is evidencing, you only have to come up with the difference of $330 because you already paid $20,000. And whoever is holding that deposit has to credit that to this settlement statement, and that will be reflected in here as well. Principal amount of new loans. So if you're getting a loan for $300,000, that's going to be shown here as a credit because you don't have to come up with that cash at closing, but that the seller sure as heck is going to want the whole amount of money for their house at the time that they sell you the house. So they don't really care that you're getting a mortgage for $300,000. They're getting the whole amount up front. And then if there are any additional loans taken subject to, that's normally seller financing. So what is on the seller side? Pay off a first mortgage, pay off a second mortgage. So if you're selling a house for $300,000 and you have a mortgage on the house for $200,000, well, you're only going to get $100,000 cash or a check at closing. You're not going to get the whole amount of your house because they're going to deduct how much it's going to cost to pay off your existing mortgage. And that payoff will have been calculated and verified in advance by the title company. If there's a second mortgage, they're going to have that on here as well. You notice there's other blank lines in case there's other amounts due from borrower or amounts you have to take off from the seller. It could be that in some cases there have been recent repairs done on the house. Maybe a contractor put on a $20,000 roof that's not paid for yet. That has to come out of proceeds. Here's more adjustments for taxes unpaid by seller, prorations, and the total paid by borrower goes here, and then the cash at settlement from the borrower is the difference. So if you add up all the stuff you have to pay as a buyer and the mortgage, the deposit, and everything else is short by $6,000, that's what you have to come up with. On the seller side, total reduction from due seller, cash at settlement. That's how much you're going to walk away from the table with. And then it'll check off cash from borrower or to borrower, cash from seller or to seller. And that'll be checked off to show this is the most important line, lines 303 and 603. You will know as a seller how much cash you got coming to you, and as a buyer, how much cash you got coming from you. It's important to know this in advance because we've seen scenarios where the seller expected to get a big windfall, $100,000 at the closing, but what they didn't know is maybe they owed more on their mortgage than they thought they did. Maybe there was a balloon payment. Maybe there was unpaid interest. Or maybe as a buyer, you're thinking, well, I only have to come up with $10,000, but there's additional fees maybe that you didn't know about. Having this good faith estimate and getting this in advance so you know what you're dealing with is extremely important as a buyer and seller. And here's your settlement charges. Commissions, loan origin charge, like these are points, appraisal fees, credit report, tax report, flood report. There's going to be a proration of your mortgage payment. Again, if you're buying a house on, let's say, the 20th of the month, your mortgage payment is paid in advance. So you have to pay the rest of that month and the following next month, right? And they calculate that, how much per month. Also, insurance. Many mortgage companies require you to do a proration to have reserves deposited with the lender. So if your insurance is, let's say, $1,200 a year, that's $100 a month, and you have to pay that in advance at closing. Mortgage insurance, property taxes, same thing. They may have reserves required from you in order to get that mortgage. Title charges, here's your title insurance, lender's title insurance, title policies, and that will be amounts either the seller or the buyer pays. Normally, the owner's policy, the buyer pays, and the lender's policy, the owner's policy, the seller pays, the buyer's policy, the lender's policy, the buyer pays. So you may find those on different sides of the equation, but some of that's customary. In some counties, the buyer pays for both types of title insurance. In addition, there's recording fees. So when you have a deed and a mortgage that needs to be recorded in the official land records, the government agency, the clerk of court who records documents, is going to have fees for recording those. And sometimes some counties are pretty expensive. They could be $700, $800, $1,000 to record deeds. Those fees have to be paid, and again, it's customary. Usually in the sales contract, it'll show who's paying those fees, and it'll go on that particular side of the settlement statement. And it'll have transfer taxes, tax stamps. Different counties call it different things, but that will also go on the breakdown of the settlement fees. And then there may also be other things that are settlement charges, maybe additional appraisals, or maybe an inspection fee, and those go on the correct side. If you notice, this second page, this settlement charges page, this has 30 or 40 lines of possible charges, and they're all added up on this bottom total settlement charges, line 1400. Remember, we saw that up here, right? Line 1400. That comes in as a borrower's amount due or buyer's amount due. And you notice there are signatures on some of these pages because they do want to have both parties be aware of what these are, and at the closing you'll have to sign it. And then you'll have a comparison page. This is going to be interesting because you will get a good faith estimate of this document at some point prior to your transaction. It might be a few days, it might be a week, just depends on what it is. And that number will go on this good faith estimate line. And then the actual amount on your HUD-1 at your closing will go on this line. And it'll be a comparison. Increase between good faith estimate and HUD-1. How much did it go up or down? The government wants to know how accurate these are. It also has a section for your loan terms, initial loan amount, how many years, your interest rate, what your payment is going to be, principal, interest, and mortgage insurance if it has it. Is it a variable mortgage, yes or no? Can your balance rise, yes or no? Is it a balloon payment? Does your loan have a prepayment penalty? These are all things which the government wants to make you know you're aware of so that you're not being misled by a mortgage lender, by a seller, by a broker. And so this is the form that is used for closings. And there's different versions of it, but they all have pretty much the same format. So how does it look in real life? Well, here's an example of a simplified version of one that's filled in. This is not an actual settlement statement, but just a simplified version of how one might look. So the contract sales price is a debit. You have credits of deposit or origination charge credit, owner's policy credit. And if you notice, you come down principal amount of new loan $272, and you have your points, your appraisal fees, your VA funding fee. This is a mortgage lender from the Veterans Administration. Lender's title company, and it breaks down at the bottom the totals. Total due from buyer. In this case, the buyer gets a credit of $1,725. So the buyer comes to closing and they get a check for $1,700. Well, part of the reason is because they already paid a deposit of $2,500, and this is the VA loan where the loan amount, $272, is actually higher than the sales price because it covers all your closing costs, which is relatively uncommon, but it does happen. Certain types of loans can actually overfund the transaction to where you get a check back from closing. So with that being said, what are the important things to know about on a settlement statement? And what are the questions do you want to ask? Well, when you are entering into a contract, make sure you're aware in your purchase and sale contract who is paying for the various items. Title insurance, title fees, the commission on the real estate, the recording stamps, any prorations. All of that will be spelled out in the contract, and the escrow agent, the title company that's preparing this settlement statement, will use that contract to know which side to put each item onto. And if you're not clear on what it is, make sure you understand it. And look, anytime you're doing a contract, especially for something of that significant amount, you may want to get good legal advice, maybe from an attorney, so you know what you're getting yourself into and what the contract means. Typically, every state has a contract that's part of their realtor association. So it's going to be a standardized contract, but you can make adjustments to it as needed. Most importantly, be aware of what the terms mean so that you know what your rights are and what you can expect at closing. You also, in most cases, have the option to choose some of the providers of services. For example, things like appraisers and inspectors and title companies. You're not obligated to go with any one particular provider, because it used to be in the past that brokers were getting kickbacks from certain title companies to steer all their business there. Sure, the broker will probably suggest somebody that says, look, we do business with them and they do a good job, and that's probably true, but be aware that you have the right to pick and choose some of the providers of these services to make sure you're getting a good deal. Make sure that they don't have a closing cost of $10,000 where everybody else charges $800 or whatever the case might be. Look at these charges carefully. Don't just look at the bottom and say, well, how much do I have to have cash from borrower? Look at each charge. Make sure they're correct. Make sure your mortgage amount is correct. Make sure that if they're estimating X amount for homeowners insurance for your escrows, that you actually have provided a copy of the insurance statement so you know that's correct. You don't want the escrow to be too high or too low. Give you an example. Let's say on this closing statement, they escrow your homeowner's insurance at $100 per month or $1,200 per year. Well, your mortgage is going to collect a payment from you within your mortgage payment every month of $100. At the end of the year, they're going to pay your premium for your insurance. They're not going to leave it up to you to pay for your insurance, because if you don't pay it and you foreclose, now the bank is on the hook for a house with no insurance, which could put them in bad position. But what happens if your insurance policy only cost $800? Well, now you paid $400 throughout the year extra for an insurance escrow. Now, they'll probably credit it back, but why give them a free loan? On the other hand, if your insurance policy is actually $1,800 a year and they're only collecting $100 a month or $1,200 total, that means at the end of the year, they're going to sock you with a big bill of covering the difference of $600. You probably don't want that either. So what you want to do is have the homeowner's insurance escrow estimate to be fairly accurate. So get a good homeowner's insurance quote. You have to have the policy in place before closing anyways, so make sure the correct amount is on there. Same thing with property taxes. Make sure that the property tax amount that's being estimated is reasonably accurate. Now, what you may find is, in most states, your new tax bill after you buy the house will be higher than what it was with the prior owner. Because in most states, the property tax assessment, the value is based on the market which your sales price is going to make a new market for that house. So if the last sale price for the house was $200,000, every year they may have bumped it up a little bit, 205, 211, 214, whatever it is throughout the years, but it probably did not catch up to the actual sale price. So if the property tax was, let's say, $2,200 a year, and you buy the house for $400,000, your tax bill for the year might be $4,000. And if you don't escrow the right amount, again, you could get socked with a big surprise bill for money you didn't count on having to spend to cover the taxes. Make sure the escrows are correct. And at the end of the year, make sure you get a good settlement from the mortgage company, making sure that they actually paid your taxes, they actually paid your insurance, and it was the right amount. Check with your insurance agent. What about the title charges? Well, title insurance and settlement fees, those are all fees that normally the escrow agent collects, and it's part of their operation. Certainly they deserve a fee for their title service, right? For preparing this document, collecting the money, doing the closing, they deserve a fee. But how much should that cost be? Make sure that you ask ahead of time when that title company is being selected, how much is their closing cost? Because they vary, and it's not something people normally shop for. Is it reasonable for a $600 or $700 settlement fee? Maybe it is. It depends on the market. But if all of a sudden you get a settlement statement with $3,000 on it, it's going to be too late at the day of the closing to shop around for a new settlement company because they already did the work. What about title insurance? Well, title insurance is usually required by a lender's policy, and you'll have to pay that. But what about an owner's policy? An owner's policy is optional. You may or may not want to select it. It's normally an insurance policy issued by the title company that you can choose to buy or not buy. But you can always ask them also what is their cost and how can they make that advantageous to you. Remember, title insurance is optional, but the price is usually a fixed price. They can't negotiate the price because it's filed with the state. But you may be able to offset that in terms of other title services. You can ask them. Agent's portion of the total title insurance premium. What does that mean? Well, they're going to get a commission on that title insurance. So whatever the title insurance policy is, let's say it's $1,200, they're going to receive a commission for producing that policy. And you'll see what that amount is here. And then the underwriter will also get the rest of it, the title actual company. So prior to buying a property, once you're under contract, you might want to get a blank settlement statement. And you could download one from our website. You can download one from the internet and print it out and put in the numbers of what you think are going to be accurate ahead of time. Even though you may not get one of these from the title company for a week or two after you do your contract, if you have one in advance and you start sketching it out to get an idea of what your place might be at closing, cash from borrower, you know what you need to come up with. And you can see how close you are. And as you start to get numbers in from different places, like how much is your appraisal, how much is your taxes, you'll be able to start to put those in and get an idea of where you stand. And you want to keep track of this because the last thing you want to do is have a big surprise at closing of how much money you have to come up with, or if you're a seller, how much money you're going to walk away with. You want to make sure you know what your tax escrows are. You want to know what your mortgage balance is. Look, if you sell a house for $400,000 and you figure I'll have a mortgage for $220,000, so that's going to leave me $180,000 at closing, cash from seller, or cash to seller, I should say, cash to seller, $180,000. If you're expecting $180,000, but then all of a sudden you find out that your escrow for taxes for half the year is going to take away $4,000. And maybe your HOA assessments is going to take away $1,000, and you may have some title fees you have to pay that's part of your contract. Next thing you know, instead of walking away with $180,000, you're walking away with $168,000. That might be a big difference in terms of what your plans are. If you have a deposit on another house that you need that money for, you want to know in advance how short you're going to be, or maybe how much more you have. You also, before you start going under contract, you want to get a first mortgage payoff. You want to contact your lender in advance and have them tell you how much is owed, like a payoff amount. Don't go by what you think you paid off. If you had a mortgage originally for $400 and you paid $2,000 a month for 10 years, you did not pay $25,000 or $200,000 off the mortgage, I should say. $200,000 off. A lot of it was interest. So you want to get an accurate payoff. If you have a second mortgage, get an accurate payoff of that. A lot of times what you think your mortgage principal balance is different than what it actually is with the bank. It may be more, maybe less, but you want to get accurate mortgage payoffs before you even accept a contract, because that may make a difference of what offers you're going to accept or how you're going to price your house, knowing your mortgage balance. So make sure you understand on the seller side what's going to be coming out of your proceeds, so you're not disappointed at closing that, hey, where's my check for $180,000? I only got $168,000. And there'll be a good reason why, but at the closing is not the time to be facing that, because it's very stressful, and you may have to make other important decisions at closing that you don't want to interrupt by having some stress or anxiety about a short proceeds. And also ask the title company how you're going to get those proceeds. Are they going to wire transfer it? Are you going to get it in a cashier's check? That way you'll know what your timing is. There's also an important factor to be aware of as a buyer and really a seller in terms of connecting wire transfers with this settlement company. There's a lot of potential risk involved for fraud, where there's people that are stealing people's down payment money or stealing their settlement money, and there's some ways that you can prevent that from happening. Your title company will help you prevent that by making sure you don't wire money to the wrong place or tell the title company to wire it to the wrong place if you're a seller. And we'll create another video about verifying escrow amounts so you don't get in a position where you miss out on proceeds or your entire down payment is lost to a scam. It's an important risk factor to take a look at. Hopefully that gives you some ideas about settlement statements and HUD-1 statements, and we're glad to be of assistance.